we have made an entry into two new segments, two new regimes, one in premium hair oils with Dove Elixir and one in the male styling range with Bill Cream during the quarter. Next chart, please. This chart really gives you a little bit detail about the portfolio of Dove Elixir which we have launched. As I said earlier, these are precious hair oils with real ingredients, and this will really enable Dove as a brand to exploit the untapped potential of the premium oils market. There are three variants, and it delivers the power, as I said, of overnight oiling in just 30 minutes. So that's a little bit of detail on the Dove oil launch. Can we move to the next chart, please? Coming now to oral care, where we've seen accelerated double-digit growth during this quarter. Both our brands, Close-Up and Pepsodent, grew in double digits. Close-Up gained from its relaunch in the previous quarter, while in Pepsodent, growth was led by the premium segment. Can we move to the next chart, please? Beverages, as I mentioned earlier, this has been a very strong quarter of growth in beverages. Tea has delivered one of its strongest quarters of growth. The growth has been broad-based. We've seen a step up in performance in Three Roses, in Red Label, and in Taj Mahal. And at the same time, our market development focus in building the tea bags as a segment is continuing to give us good results. At the same time, we've also seen good performance in our coffee portfolio, which has maintained its double-digit growth momentum. Within the premium offerings that we've launched over the last 12 to 18 months are continuing to do very well. Can we move to the next chart, please? Just a little bit of detail to elaborate on our tea performance. You will see this chart gives you a flavor of the variety of interventions that we've been making to step up the growth on tea. We have strengthened our core behind Three Roses and Red Label with the proposition of health and taste, and this has been backed by a very exciting and interactive consumer campaign that has worked well for the brand. At the same time, we're going deeper in the markets with access price point packs, while also using and driving market development to upgrade consumers with offerings like tea bags and natural care tea variants. So overall, a very strong quarter on tea. Next chart, please. Coming on to packaged foods, where admittedly the growth of 8% is below our expectation. Growth in packaged foods has been led by Kissan and Knorr. Kissan Ketchup sustained double-digit growth, while Knorr Soups had a very strong performance in the quarter. As I mentioned earlier, towards the end of the quarter, we relaunched Knorr Soupy Noodles with a superior mix, and really during December quarter, we took actions to manage the pipeline so that the Knorr Soupy Noodles relaunch could come in and get access by consumers quickly. Quality Walls, which is our ice cream business, registered a modest growth, impacted by the challenging environment, including the slowdown in discretionary categories that I talked about. As we look ahead, we are building strong summer plans so that we can accelerate the growth of this exciting business. Next chart, please. Finally, coming to Pureit, I think we're quite pleased with the performance of Pureit. It continues to strengthen its leadership in an environment where consumer durables as a market segment are clearly slowing. Our portfolio is stronger with the innovations that we brought to market, and we are seeing good progress on the various initiatives to drive execution and efficiency. Next chart, please. As we do always, sharing with you the reported results and the comparable results to take into account the base effect of FMCG exports that got demerged post-December quarter. So as you can see, our reported growth, while it is 10%, the comparable growth is there of 15%, and therefore I mentioned earlier our domestic consumer business grew by 15%. Overall, at a bottom line level, PAT BEI grew by about 15% and net profit by about 16%. Next chart, please. If you look at how our operating profit translates into net profit, there's been a clear contribution from the other income, which is really the work that we do on treasury in managing our positive cash, as well as dividend from subsidiaries, etc. In terms of exceptional items in the quarter, which you see at a net cost of 7 crores, it is a combination of profits from disposal of surplus properties of about 25 crores, while restructuring costs of 32 crores were incurred during the quarter. Effective tax rate, which is in line with what we have talked about earlier for this financial year, is at 24% in this quarter, close to the 24.5% that we've talked about earlier. Next chart, please. So in summary, I would characterize the December quarter results as reflecting consistent broad-based growth along with margin and profit improvement, 15% growth in our consumer business, and a 15% growth in profit after tax before exceptional items. The strategy that we've been working on is clearly on track and delivering results. Next chart, please. I'd just like to take a moment to share with you how our performance looks over the first 9 months of this financial year. Next chart, please. If you look at our 9 months performance, our domestic consumer business has grown by about 16% with an underlying volume growth of 7%. Operating margins have been expanded by 100 basis points, and our profit after tax before exceptional items is up 27%. Net profit is up much higher, benefiting from the property disposals, in particular the Bulita disposal in June quarter. Next chart, please. Finally, a few words on how we see the scenario panning out as we look ahead. I think firstly, as we've been consistent for quite some time now, the medium to long-term outlook for FMCG markets remains very positive. Given our strong portfolio of brands and our superior capabilities, HUL is very well positioned to leverage these opportunities and deliver consistent performance. In the near term, we are conscious of some concerns. One is obviously the continuing volatility in global and local environments. And second is the inflationary pressures, which will put some stress on consumer wallets. In this context, I want to reconfirm that our commitment is to deliver competitive, profitable, consistent and responsible growth, which is what I talked about when we started this presentation. So with that, let me hand over to Nitin for his perspectives on our performance. With that, let me just move forward before handing over to him on the one other press release that we issued during the day. Can we have the next chart, please? Now, some of you would have seen a press release that we issued along with our results press release, but what I'd like to do in a few charts is just to highlight the context and the details of the change in the royalty agreement that has been approved by the Board of Directors today. You will see up on this chart a little bit of background. I'm sure many of you are familiar with it, but let me nevertheless take you through it. In the recent years, Unilever has been increasingly globalizing the resources to provide greater expertise, superior innovations, and scale advantages to all Unilever operations across the world. Alongside this, there's a clear increase in the emphasis on the developing and emerging markets, including markets like India. As you've seen over the last couple of years, the pace of innovations has clearly stepped up, and also the scope of services that we get from Unilever has been expanded. Now, HUL has been enjoying the benefits of this increasing stream of innovations and other services. It is also very clear to all of us that the India growth opportunity is quite large and very attractive. But at the same time, we will see increased competitive intensity in this attractive market. In order that HUL continues to deliver superior and competitive growth and profitability in this attractive market, it is important that we continue to have access, in fact, I would say greater access to the stream of innovation and other advantages from Unilever. Unilever is committed to supporting HUL to win in the marketplace and thereby generate shareholder value for all shareholders. Next chart, please. Just to share with you a few examples of specific advantages and benefits to HUL from what we see from Unilever. There are three blocks that you see in this chart. The first block is an indexed representation of the innovation turnover that we've been getting, and you can see over the last couple of years how this has got stepped up. This block in the middle just takes a few categories to give you a sense about how they are helping us drive faster growth and at the same time be accretive to the gross margins. In this, you've got face wash, hair conditioners, fabric conditioners, where these have grown in CAGR terms by 6x that of the HUL average, with gross margins that are 1.6x that of HUL. So they are accretive to our top line and they are accretive to our gross margin. And a third example is the leverage that we get from our global procurement and buying capabilities, both in terms of better rates as well as in terms of payment terms. At the same time, access to the innovation that comes through from our suppliers anywhere in the world. Next chart, please. In the context of all the changes that I talked about earlier, the increased globalization, etc., there was a request from Unilever to the HUL board to review these arrangements. As you are no doubt aware, our current royalty agreements have an effective royalty cost of about 1.4% of turnover. Based on the request of Unilever and all the other aspects of change that I referred to earlier, we did a detailed evaluation with rigorous due diligence, which was led by senior members of our team. At the same time, we've also looked at how our rates of royalty benchmark across the peer group. Following this detailed review and the due diligence, the board has today in its board meeting approved the proposal to enter into a new agreement, which will be effective from 1st of February 2013. Next chart, please. What's the summary of the new arrangement? So, as I said, the new agreement will be effective from 1st February 2013 against an existing royalty cost of about 1.4% of turnover. It will increase in a phased manner over the next 4 or 5 years, no later than financial year ending March 18, to 3.15% of turnover. So over this period, the total increase will be about 1.75% of turnover. In the immediate period, which is 1st February 2013 to 31st March 2014, the increase in royalty cost is estimated at 0.5% of turnover. So this is really a very quick summary of the royalty review and the change that we've detailed out in the press release, which would now be on our website. And with that, let me now hand over to Nitin. Person who's managing the chart could just move to the next chart. And Nitin, let me hand over to you to give your comments before we open it up for questions.
Thank you, Sridhar, and thank you to all of you who've joined this call. You've just heard Sridhar talk about the performance in the quarter. Let me start by saying that in the